Stop looking at interest rate charts. Stop refreshing your portfolio. Stop listening to financial media telling you everything is fine. We need to examine something far more critical developing right now. Something that hasn't been seriously tested in 40 years. Something that could trigger one of the largest wealth transfers in modern history. The potential breakdown of Federal Reserve independence. Based on recent political rhetoric and historical patterns, we're analyzing a scenario that may unfold over the coming months. One where the traditional separation between the White House and the Federal Reserve comes under sustained pressure. What I'm about to show you will fundamentally change how you see your savings, your investments, and the economic system itself. Because this isn't just about political tensions. This is about whether the foundational rules of the monetary system can withstand political pressure. And if they can't, what happens to your wealth when that framework begins to fracture? Here's the scenario financial analysts are increasingly concerned about. In a potential second Trump presidency, based on his previous statements and recent public commentary, there is growing probability he could escalate pressure on Federal Reserve leadership over interest rate policy. Recent public statements have suggested that the Fed chair may be making policy errors, that interest rates should be substantially lower, and that presidential authority over Fed governance might be broader than traditionally understood. When statements like these emerge from senior political figures, institutional markets begin pricing in risk scenarios. And we are already seeing preliminary market responses. Dollar volatility has increased during periods of Fed White House tension. Gold ETF inflows have accelerated during political uncertainty windows. Treasury yield spreads have widened when central bank independence questions emerge. Now, let me explain what this scenario could mean. What we're examining is not just a political disagreement. What we are analyzing is the potential erosion of the single most important structural element in the global financial system, the framework of central bank independence. When that framework shows cracks, when markets begin to question whether the Federal Reserve can operate insulated from political pressure, when foreign governments start to wonder if American monetary policy might become subject to electoral cycles, the dynamics change fundamentally. And here's what makes this scenario particularly dangerous. The mechanisms are already built into the system. The legal ambiguities exist. The political incentives are clear. The historical precedents are well documented. We're not talking about some distant theoretical risk. We're analyzing a scenario with clear catalysts, observable warning signs, and a well-established historical playbook. Let me show you exactly how this works. Let's examine the historical foundation, the 1951 Treasury-Federal Reserve Accord. After World War II, the Federal Reserve operated essentially as an extension of the Treasury. The government directed interest rate policy. The Fed complied. Economists call this fiscal dominance, and it produced predictable results, persistent inflation, because political incentives consistently favor accommodative monetary policy. It's how governments fund programs, avoid difficult fiscal decisions, and maintain electoral support. So, in 1951, an institutional agreement established Fed operational independence. It would set monetary policy based on economic mandates, not political preferences. This framework became foundational to the dollar's role in the global system. Why? Because foreign governments and institutional investors needed confidence that the United States would not simply print money to solve political problems. They needed to believe the Federal Reserve would maintain price stability even when it created political friction. That confidence underpins approximately $7 trillion in foreign-held U.S. Treasury securities. Now, what happens when that confidence framework begins to show stress? Historical patterns suggest that when Fed independence questions emerge, foreign Treasury holdings tend to experience net reductions. Market pricing mechanisms begin demanding higher risk premiums. International capital markets respond, and that response could create self-reinforcing dynamics far more damaging than the original policy dispute. Here's where it gets legally complex. The Federal Reserve Act of 1913, Section 10, states the president may remove any member of the Board of Governors for cause. For cause? The statute doesn't precisely define this term, and critically, it has never been tested in court. Not once in 112 years. The 1935 Supreme Court ruling in Humphrey's Executive versus United States established that, for cause, removal requires demonstrating inefficiency, neglect of duty, or malfeasance in office. One potential legal argument might claim that maintaining interest rates counter to presidential economic coordination constitutes such grounds. However, the overwhelming consensus among constitutional law experts is that this interpretation conflicts with the fundamental purpose of Fed independence, that the chairman explicitly does not take policy direction from the executive branch. But here's the critical insight. A president does not need to win this legal argument to create significant market impact. The legal uncertainty itself becomes the risk factor, because markets don't price in outcomes. Markets price in probability distributions of potential outcomes. And the probability distribution right now includes scenarios where the United States moves toward fiscal dominance, where monetary policy increasingly serves fiscal objectives, where the central bank's balance sheet finances government deficits, where inflation becomes a fiscal management tool. Let me show you what that transition looks like in practice through historical case studies. Historical case studies reveal a clear pattern. Turkey, 2018-2023. Presidential pressure for accommodative policy led to multiple central bank governor replacements. Inflation trajectory moved from single digits to above 80%. Currency depreciation exceeded 90% against hard currencies. Argentina, 2015-2023. Central bank financing of fiscal deficits became structural policy. Average annual inflation exceeded 50%. Currency became progressively less functional as a store of value. These aren't third world anomalies. These are G20 economies with sophisticated financial markets. In both cases, started the same way. Political pressure, compromising central bank operational independence. But the United States is fundamentally different, you might think. We're the global reserve currency. Precisely, you are the global reserve currency in significant part because the Fed maintained operational independence. And if that framework comes under sustained pressure, the reserve currency status itself becomes questionable. Now let me show you how sophisticated capital is already positioning for this risk. Recent market data shows patterns consistent with institutions hedging central bank independence risk. Gold ETF flows have shown substantial net inflows during Fed White House tension periods. Silver futures open interest has increased, suggesting institutional positioning for monetary uncertainty scenarios. Options markets show elevated implied volatility in precious metals relative to historical norms. U.S. Treasury market dynamics reveal even more. Longer duration Treasury yields have experienced upward pressure during political monetary friction episodes. This suggests bond market participants are beginning to price in risk premiums. TLT, the long duration Treasury ETF, has shown elevated volatility patterns. Let me translate the mechanism. When Treasury yields rise, it indicates investors are demanding higher compensation for holding U.S. government debt. The economic interpretation. Perceived risk has increased. Risk that monetary stability could be compromised. Risk that inflation expectations might shift. And when yields rise, government borrowing costs rise proportionally. With approximately $36 trillion in outstanding federal debt, every 100 basis point increase in average borrowing costs represents roughly $360 billion in additional annual interest expense. Consider the scenario dynamics. If political pressure succeeded in forcing near-term rate cuts, it might create temporary fiscal relief. But if that pressure simultaneously destroyed Fed credibility, if it triggered a systematic loss of confidence in dollar stability, if it forced bond markets to demand a permanent independence risk premium, the long-term borrowing cost increase could substantially exceed any short-term savings. This represents the structural trap that has appeared in historical currency crises. Political actors demand accommodative policy. The central bank complies or is forced to comply. Initial inflation appears. Investor confidence erodes. Interest rates spike as markets demand compensation. Government debt service becomes unsustainable. The central bank increases monetary accommodation. Inflation accelerates. Confidence collapses. Currency enters crisis. This pattern has repeated across dozens of currency failures since World War II. Let's model this scenario step by step, based on historical precedent and current market structure. Phase 1. Sustained pressure campaign. Political pressure on Fed leadership continues through public statements and policy discussions. The Fed maintains its operational mandate based on economic data. Likely market impact, increased volatility. Equity markets experience wider trading ranges. Precious metals trend higher as monetary uncertainty hedges. Dollar experiences modest weakness, but remains within normal bands. Phase 2. Institutional stress. Political pressure escalates to include discussion of governance changes or leadership replacement. Legal uncertainty increases as constitutional questions enter public debate. Potential market impact, significant volatility and risk repricing. Foreign official sector treasury holdings could experience net reductions. Currency could depreciate 5 to 10%. Gold might test significantly higher levels. Equity markets could enter correction territory. Phase 3, resolution scenarios. This branches into two substantially different paths. Scenario A, framework. Preservation. Legal or political resolution reinforces Fed independence. Markets stabilize. Dollar recovers. This represents the constructive outcome. Scenario B, framework. Erosion. Fed operational independence experiences material compromise. New leadership signals. Greater policy coordination with fiscal authorities. Interest rate policy shows political influence. Phase 4, systemic repricing. Scenario B only. International capital market responses could become self-reinforcing. Foreign official sector accelerates treasury portfolio reduction. Dollar enters sustained depreciation. Import price inflation increases. Domestic inflation pressures reemerge. The Fed faces an impossible choice: raise rates and induce recession, or maintain accommodation and accept currency debasement. Bond market dynamics potentially break down. Yields could spike towards 6 and 7% plus as markets price in structural inflation risk. The government faces funding stress. Historical pattern suggests the captured central bank response: monetary financing. And that's when the wealth transfer mechanism activates. Here's what you need to understand about inflation as a wealth distribution mechanism. Inflation represents a transfer from fixed nominal value instruments to real assets, from creditors to debtors, from cash positions to hard assets. In a scenario where inflation runs 7 to 10% with 2 to 3% deposit rates, cash holders experience 4 to 7% annual purchasing power erosion. Wages might increase 3 to 4%, but essential consumption could increase 10 to 15% if currency debasement accelerates. The economic effect is wealth extraction from wage earners and savers. Meanwhile, government debt gets inflated away in real terms. Obligations incurred in current dollars get serviced in future dollars, worth potentially 30-50% less in purchasing power. This is the hidden default mechanism. But here's the key insight. If you understand the scenario risk in advance, you can position on the constructive side of the transfer. Public filings show certain institutional investors have substantially increased precious metals allocations. Prominent macro fund managers have publicly discussed holding gold, hard commodities, and real assets while reducing long-duration fixed income exposure. Sophisticated capital isn't waiting for scenario confirmation. They're already hedging the risk. Now, let me show you a market structure element most analysis overlooks. Recent COMEX data shows warehouse gold inventory at approximately 19-20 million ounces, while open interest in gold futures represents claims on approximately 90-100 million ounces. The structural observation: claims represent roughly 5 times the physical inventory available for potential delivery. Normally, this functions without stress because most futures contracts settle financially. The paper market serves price discovery and hedging functions. But consider the scenario dynamics if confidence in currency frameworks experiences serious deterioration. When institutional investors and foreign official entities prefer physical possession rather than financial exposure, they request delivery. And when delivery requests substantially exceed available physical supply, market structure faces 2 potential outcomes. Price adjusts sharply upward to ration limited physical availability, or settlement occurs through cash rather than physical delivery, potentially undermining confidence in paper to physical conversion mechanisms. We observed a preview in March 2020. Gold futures prices traded substantially above physical spot prices because delivery logistics broke down. The basis inverted. Market structure experienced temporary failure. That was liquidity stress lasting approximately 3 weeks. What I'm analyzing is potential confidence stress that could persist for extended periods. If a scenario unfolds where Fed independence erodes, where dollar framework questions become serious, where foreign official sector rushes to convert paper metals exposure into physical holdings, the COMEX delivery infrastructure may not be designed to handle that volume. And when paper to physical conversion mechanisms experience stress, when leverage ratios compress from 5:1 toward 1:1, the repricing could be substantial. Now, let me show you the historical precedent. August 15th, 1971. President Nixon suspends dollar convertibility to gold. The United States effectively defaults on the Bretton Woods commitment to redeem dollars for gold at 35 per ounce. The cause: foreign governments were demanding physical gold delivery at rates that would exhaust U.S. reserves. Claims exceeded supply. The conversion window closed. In the decade following that framework change, gold prices increased from $35 to approximately $850, roughly 24 times appreciation. The mechanism: once the dollar lost its gold anchor, once the Federal Reserve could expand the monetary base without physical redemption constraints, once inflation accelerated above 10% annually, gold repriced to reflect the new monetary reality. Now examine the current scenario through this historical lens. We no longer operate under a gold standard, so Nixon's exact situation cannot repeat. But the underlying mechanism shows clear parallels. When confidence in the currency issuer experiences erosion, when central bank independence comes under pressure, when monetary policy becomes aligned with fiscal objectives, assets that cannot be created through policy become primary wealth preservation vehicles. In 1971, that meant gold. In the current scenario, that could mean gold, silver, and real productive assets. The critical difference: today the dollar underpins over $100 trillion in international contracts and debt. If the framework experiences serious stress, repricing might involve systemic revaluation across global markets. So what's the appropriate response to this scenario analysis? You're observing potential political pressure on Federal Reserve independence. You're seeing preliminary market responses suggesting institutions are pricing this risk. You're watching precious metals react to monetary uncertainty. What should you consider right now? First, understand the timeline. This is not a binary next week event. This could develop over months or years. You have time for thoughtful analysis, but the risk window may be narrowing. Second, assess your exposure profile. What percentage of your wealth sits in dollar-denominated instruments? How much exposure do you carry in long-duration bonds that could experience substantial losses if yields spike? How much sits in fixed income structures that lose purchasing power during inflation scenarios? Third, consider hard asset diversification. I'm not suggesting panic selling of traditional portfolios. I'm suggesting that if your allocation includes zero exposure to assets that perform well during currency framework stress, you may be taking on unhedged risk. Historical portfolio analysis suggests 10-15% allocation to precious metals represents reasonable diversification. Gold for wealth preservation, silver for potential upside given industrial demand dynamics. Consider physical ownership versus financial instruments. ETFs provide liquidity, but physical possession eliminates counterparty risk if financial system stress scenarios develop. Fourth, maintain analytical perspective. The mainstream narrative may suggest this political tension represents routine disagreement that will resolve without consequence. They may be correct, but they might not be. And the cost of incorrect assessment could be substantial if you maintain zero hedging. I don't claim to know whether political pressure on the Fed will escalate to crisis levels. I can't predict court rulings. I can't forecast whether this resolves constructively or destructively, but I can identify this. The risk is real. The historical mechanism is well documented. The warning indicators are visible. Historical analysis shows that when executive branches pressure central banks, adverse outcomes frequently follow. Economic theory demonstrates that when dollar reserve status faces credible threats, capital flows toward hard assets. Monetary history shows that gold has preserved purchasing power through every major currency disruption. And risk management principles suggest that insurance should be purchased before crisis events materialize, not during the crisis itself. We're examining a potential inflection point in monetary framework stability. You're observing stress indicators that could represent early warning signs. Don't let mainstream dismissiveness prevent prudent risk assessment. Don't let normalcy bias convince you it cannot happen in developed markets. It has happened. And current dynamics suggest it could happen again. The question is, which side of potential wealth transfer will your portfolio positioning place you on? This is Bullying Beyond. If this scenario analysis helped you understand the risks developing beneath mainstream headlines, hit that like button. If you want to continue following this framework of stress analysis, subscribe and turn on notifications. Sophisticated capital is already positioning. But the question is, are you thinking about these scenarios? I'll see you in the next analysis.